Hello, this is Isra Naur and welcome to the third episode of Stock Market Made Easy. In this episode, I'm going to teach you how to fundamentally analyze a stock before investing in it. Investing in the stock market can feel like navigating a maze, especially if you're new. But what if I told you there's a method to this madness? Today we're breaking down fundamental analysis step by step so you can make confident, informed investment decisions. Stay with me because by the end of this video, you'll know how to evaluate a company like a pro. So what is fundamental analysis? It is like getting to know a company inside out. Imagine you're buying a house. You wouldn't just look at the paint. You'd check the foundation, location, and value for money. Fundamental analysis does the same for stocks. It helps you figure out if a company's stock is worth the price or if it's like paying $100 for a $50 pair of shoes. By understanding its true value or intrinsic value, you can decide if it's a good deal. Step 1. Understand the business. Start with the basics. What does the company do? For example, Apple makes iPhones, Amazon dominates e-commerce, and Coca-Cola sells beverages. But it's more than just knowing the products. You have to ask two questions. Does this company solve a real problem? Are people likely to need their products in the future? For instance, renewable energy companies are growing because the world is moving towards sustainability. The more essential the business, the safer your investment. But knowing what a company does isn't enough. You need to know how well they do it. That's where financial statements come in. Step 2. Check the financial statements. Think of financial statements as a company's health report. There are three key documents. Number 1. Income statement. This shows how much money the company is making or losing. Look for steady growth in revenue because if a company isn't making money, how will it reward investors like you? Number 2. Balance sheet. This is like a snapshot of what the company owns and owes. Assets are what they own, like buildings, equipments, or cash. Liabilities are debts. A strong balance sheet means a company can handle challenges like a bad economy. Number 3. Cash flow statement. Profit is great, but cash is king. This tells you if the company has enough cash to pay its bills and invest in growth. Even profitable companies can fail if their cash flow is poor. Now let's connect the dots by using some powerful tools. Financial ratios. Step 3. Analyze key ratios. Ratios simplify the numbers and give you quick insights. Here are the most important ones. Number 1. Price to earnings (PE) ratio. The PE ratio tells you how much you're paying for every dollar the company earns. Think of it like this. Imagine you're buying a vending machine. This vending machine gives $10 in profit every year. If the machine costs you $100 to buy, the PE ratio is 100 divided by 10, which is equal to 10. This means you're paying $10 for every $1 the machine earns each year. Low PE ratio means the stock is cheaper compared to its earnings. High PE ratio means the stock is expensive, but it might also mean investors believe the company will grow and earn more in the future. Number 2. Debt to equity ratio. This compares what a company owes, which is debt, to what it owns, which is equity. A D ratio of 1 means it owes as much as it owns, which is manageable. But higher than that could mean trouble. Number 3. Return on equity. This measures how well a company uses investors' money to make profits. Think of it like planting seeds. ROE shows how much fruit you get for each seed you plant. Higher is usually better. Now you know the numbers, but numbers don't run companies, people do. Let's talk about management. Step 4. Evaluate the management. A great company needs great leaders. Imagine a ship in the middle of the ocean. The quality of the captain decides if it reaches the shore. Research the management team's background. Have they led companies to success before? Are they making bold or smart decisions for the future? For example, Elon Musk's vision helped Tesla revolutionize electric cars. Strong leadership often means strong results. But even the best leaders can fight against market trends. Step 5. Understand the market trends. Some industries grow fast while others fade. Think about the rise of online streaming versus the decline of DVD rentals. Investing in a company with the wind at its back, like green energy or AI, can boost your returns. But remember, trends come and go, so always stay informed. Alright, you've done your research. Now let's tie it all together with a real world example. Let's analyze Apple. In terms of revenue, it's been growing consistently, driven by products like the iPhone and services like iCloud. In terms of PE ratio, it's higher than some competitors, but investors are willing to pay more because they believe in Apple's future. And in terms of leadership, Tim Cook has expanded Apple's ecosystem while keeping it highly profitable. This mix of strong financials, smart leadership, and a booming industry makes it a solid choice for many investors. Now, are you feeling confident? Great! But let me quickly warn you about common mistakes so you don't fall into traps. Number 1, don't buy stocks just because they are popular. Always do your research. Number 2, don't ignore debt. Too much debt can sink a company. Number 3, don't expect instant results. Fundamental analysis is a long-term game. Fundamental analysis is your roadmap to smart investing. It takes time and patience, but the rewards are worth it. Remember, you're not just buying stocks, you're buying businesses. Keep learning, stay curious, and you'll make informed decisions. Like this video, share it with a friend starting their investment journey, and subscribe for more tips to grow your wealth. See you in the next one.